Today, we will talk about financial statements and how to read them. Financial statements are written records that convey the business activities and the financial performance of a company. They are often audited by government agencies, accountants, firms, etc. to ensure accuracy and for tax, financing, or investing purposes. For-profit primary financial statements include the balance sheet, income statement, statement of cash flow, and statement of changes in equity. Non-profit entities use a similar but different set of financial statements. Investors and financial analysts rely on financial data to analyze the performance of a company and make predictions about the future direction of the company's stock price. The annual report is a key resource of reliable and audited financial data, containing the firm's financial statements. The balance sheet provides an overview of a company's assets, liabilities, and shareholders' equity as a snapshot in time. It helps to understand a company's financial health at a specific point in time. The income statement covers a range of time and provides an overview of revenues, expenses, net income, and earnings per share. It helps to understand a company's profitability over a certain period of time. The cash flow statement measures how well a company generates cash to pay its debt obligations, fund its operating expenses, and fund investments. It provides insight into a company's financial footing and where its money is coming from and going to. This statement tracks total equity over time, which ties back to a balance sheet. It records how profits are retained within a company for future growth or distributed to external parties. This statement summarizes standard net income while also incorporating changes in other comprehensive income. It shows a company's total change in income, including gains and losses that have yet to be recorded. Non-profit organizations record financial transactions across a similar set of financial statements, but there are differences due to the nature of non-profit entities. Although financial statements provide a wealth of information on a company, they do have limitations. They are open to interpretation, and users must place a level of trust in the validity of the report and the figures being shown. The three main types of financial statements are the balance sheet, the income statement, and the cash flow statement. These three statements together show the assets and liabilities, revenues and costs, and cash flows of a business. The most common line items in a financial statement are revenues, costs of goods sold, taxes, cash, marketable securities, inventory, short-term debt, long-term debt, accounts receivable, accounts payable, and cash flows from various activities. Financial statements show how a business operates, provides insight into its revenues, costs, cash management, and assets and liabilities, and detail how well or poorly a company manages itself. Financial statements can be read by comparing them to prior periods to understand changes over time. For example, comparative income statements report a company's income from different periods, informing users of the company's financial health. Generally accepted accounting principles are the set of rules by which United States companies must prepare their financial statements. It is the guidelines that explain how to record transactions, when to recognize revenue, and when expenses must be recognized. Here are 5 key takeaways. 1. Financial statements are written records that convey the business activities and the financial performance of an entity. 2. The balance sheet provides an overview of assets, liabilities, and shareholders' equity as a snapshot in time. 3. The income statement primarily focuses on a company's revenues and expenses during a particular period. Once expenses are subtracted from revenues, the statement produces a company's profit figure called net income. 4. The cash flow statement, CFS, measures how well a company generates cash to pay its debt obligations, fund its operating expenses, and fund investments. 5. The statement of changes in equity records how profits are retained within a company for future growth or distributed to external parties. Hope this would help. Thanks for watching.